Dear guests and jury members, today my team and I are going to present our equity research report on Deutsche Lufthansa AG, one of Europe's aviation giants. We, the WHU equity research team, issues a sell recommendation on Deutsche Lufthansa AG. As of May the 10th, the Lufthansa stock price stood at 6.67 euros, and we issue a target share price of 5.79 euros, indicating a potential downside of 30.2%. Lufthansa, founded in 1953 and headquartered in Cologne, Germany, has grown to become Europe's leading aviation company by revenue. Lufthansa operates through three main business segments. First, its passenger airline segment, which comprises a large portfolio of diversified airline brands. Second, its logistics segment. And third, its maintenance, repairment, and overall services, also known as MRO services. Lufthansa's international outreach and its revenue concentration of 67% within Europe demonstrate its market dominance. However, if this now sounds like an attractive investment opportunity to you, please fasten your seatbelt as we embark on our journey through our sell recommendation. Our analysis is anchored on three main rationales. First, macroeconomic sensitivity exposes Lufthansa's risk profile. Lufthansa's operations are highly sensitive to economic fluctuations, especially within Europe. Second, aggressive competition will undermine margins. The intensifying competitive landscape within the aviation industry due to low-cost carriers will erode Lufthansa's profit margins. And third, German base leads to a structural disadvantage. Now, with these three rationales in mind, let's delve into the industry's dynamics. The German travel sector's recovery from COVID-19 presents a rather concerning outlook. Leisure travel remains 23% down compared to pre-pandemic levels, and business travel, which is a key profit generator for Lufthansa, lags even further behind, with 30% down. Now, this is not just a mere transitional phase after COVID-19, but rather reflects deeper and lasting changes within the industry. And this is due to three main factors. First, a shift to more remote work. Second, corporations cutting their travel budgets. And third, an increasing awareness for more sustainable travel options. These factors reshape the industry's demand and also change travel behavior for the long run.
Lufthansa experiences high pressure from its competitive positioning. On the demand side, Lufthansa offers poor quality for high prices. Ticket prices per kilometers average among the highest in its industry, while service quality has fallen behind the competition in recent years. Hence, aggressive competition will decrease margins, as we mentioned in our second investment hypothesis. While on the supply side, as Lufthansa is German-based, the wage level of Europe is reflected. Moreover, Lufthansa, together with Air France, has the second highest wage level in Europe itself. Finally, in the future, the shortage of pilots will increase, and so will cost of personnel do.
Let's now take a closer look at the financial analysis. The first thing I would like you to notice is the sharp drop in revenue and in EBIT margin in 2020 and 2021. Of course, this was due to the COVID-19 pandemic, but it again highlights Lufthansa's sensitivity to the macroeconomic environment, which is our first sell rationale. Looking at the future, we expect Lufthansa to bounce back to pre-pandemic revenue and then reach its long-term revenue growth rate of 2% by 2030. Overall, revenue growth will be 33% until 2030. However, if you take a look at the yellow line, EBIT margin will actually decline. Why is that? Well, looking at the cost drivers, you can see that most major cost drivers exceed the 33% revenue growth. And staff costs in particular will increase by 47%, mainly driven by the German base. Finally, looking at return on capital employed, a key profit indicator Lufthansa uses to measure its profitability, we expect it to fall behind its 10% target, behind competitors, and decrease in the long run. Moving on to the valuation, we came up with a target share price of €5.79, representing a downside of 13.2%. We chose a 50-50 blended approach of both multiple valuation and DCF. Both the multiple valuation and the DCF confirm, or sell recommendation. For the multiple valuation in particular, we chose a sum of the parts approach, valuing each of the segments, logistics, MRO, and passengers separately, and then combining them to a group EV. This ensures that there's no hidden value creation opportunity through a spin-off of, for example, the MRO segment. Taking a deeper look at the DCF, we came up with a target DCF price of €5.58 and used a WACC of 7.43% and long-term growth rate of 2.0%. As you can see, there's actually quite a wide gap between cost of debt and cost of equity. This is because the beta for Lufthansa is 1.46, which is typical for the airline industry and its high volatility. Taking a deeper look at the sensitivity analysis, you can see that our sell recommendation is actually very robust and still holds when changing some of the assumptions. Finally, taking a look at the EV to equity bridge, you can see that Lufthansa has very high interest-bearing liabilities. This, once again, makes Lufthansa very sensitive to the macroeconomic environment.
Lufthansa's ESG profile is a critical block in our analysis of sell recommendation. We have pinpointed 3 major challenges that poses substantial threat to profitability: carbon emission, human capital, and product governance. As Lufthansa's ESG rating already lies below its sector average, we believe these problems are more acute for Lufthansa than for its competitors. Firstly, to navigate aviation net zero, Lufthansa has committed to large offtake volumes of sustainable aviation fuels. However, the SAF will still be 2 to 4 times more expensive than the traditional jet fuel within the next 20 years, and the market is too premature to ensure enough supply for all the airlines to reach this goal. So these mandates only create more cost burdens as well as supply chain risks. Secondly, Lufthansa is falling behind the competitors in the race of fleet modernization. With a larger and older fleet, the current rate of replacement is too slow to make substantial environmental impact or sufficient efficiency improvement compared to aggressive competition. On the social front, Lufthansa is consistently pressured by the German labor union, highlighting again our thesis of a German-based structural disadvantage. As we have already known, Lufthansa has the second highest salary cost in the European Union. However, their staff is still unsatisfied and always demanding overpayment. And we have already seen from history that the union has taken the upper hand, and this cycle will only continue driving the labor costs higher for Lufthansa. The most recent strike in Q1 2024 has already caused a net loss of 340 million to the quarterly results and a 6% unprecedentedly high flight cancellation rates. And these strikes are behind the reasons for slipping product quality, driving customers away and undermining Lufthansa's pricing power in the face of low-cost carriers.
Based on our analysis, we have identified 4 risks to our sell recommendation. First, on a group level, cutting costs significantly and investing in operational quality could have an impact on revenue and cost, hence influencing overall earnings. Second, in the passenger airline segment, an unexpected faster recovery of the German economy could also lead to a surge in demand for airline tickets, hence also impacting our sell recommendation. The logistics segment could see a boom if the global economy would accelerate in their recovery from COVID-19, increasing air freight volumes and operational efficiencies. And lastly, the MRO segment may grow in case of stricter regulations and new technology adaptations. While all these risks may have an impact on our sell recommendation, we do believe that their overall probability remains low due to the slow pace of structural changes within the aviation industry and due to the current economic situation globally, but especially in Germany. Summing up, macroeconomic sensitivity exposes Lufthansa's risk profile. Aggressive competition will undermine margins. German base leads to a structural disadvantage. Having these 3 rationales in mind, the WHU equity research team issues a sell recommendation on Deutsche Lufthansa AG with a target share price of €5.79 and a downside of 30.2%. Ladies and gentlemen, thank you very much for your attention, and we're looking forward to further questions.
Thank you very much. You mentioned maybe not a lot, but you mentioned some serious risk, including macroeconomic, staff costs, and so on. But if you could briefly address the competition and the competitive position of the company on the market in given segments, and which one you see especially risky, and which competitors are the hardest for Lufthansa to compete with?
Sure, I'm happy to speak to this question. Well, Lufthansa has many portfolios or segments in their overall group, which many other companies don't have. For example, we see low-cost carrier models, which pushed into the market after COVID and hence increased their market share, making it more difficult for full-cost carriers like Lufthansa. As we can see here on the revenue side, we can see that the passenger segment of Lufthansa did not really recover well compared to its peers, and its overall other segments also didn't do way better than their competitors. If we take a look at slide
recovery.
Yep. And this one, we can see that Lufthansa lags even further behind with their recovery from COVID-19. We can see low-cost carrier models like Ryanair, they managed to use the COVID-19 pandemic to bounce back and come out even stronger than before, whereas Lufthansa lags the furthest behind from their pre-pandemic levels.
What's the reason for that, in your opinion?
In our opinion, we believe that Lufthansa has structural disadvantages, as we already said, due to the German base. As we can see, in the missed earnings for Q1 2024, we can see that Lufthansa had a huge impact of strikes. Also, their cargo lagged behind. And this is due to the slower recovery of the overall economy, especially within China. China didn't recover as fast as expected. Hence, for example, logistics did not really see an increase in their revenue significantly compared to pre-pandemic levels. And also, we believe that other airlines like Ryanair, which came stronger out of the COVID recovery than Lufthansa, that they are more agile than Lufthansa, as Lufthansa has many different segments, many labor unions, which make it more difficult to settle. And also, the quality of Lufthansa is steadily deteriorating. For example, Skytrax rating, Lufthansa had 5 stars before COVID, which is a superb measurement, but they weren't able to consistently hold it, and their quality decreased, not only in objective ratings such as the Skytrax rating, but also we did web scraping, and we could see that based on internet sites for airlines, the customer satisfaction went down significantly, as we already showed with the customer satisfaction score. And hence, we believe that Lufthansa is not well positioned to really bounce back from COVID, and other airlines are better positioned.
So Ryanair and EasyJet are more of a threat than Emirates, Gulf, or Etihad. Is that correct?
Is correct, yes, because the low-cost carriers, as we saw in the market slide for in our industry analysis, we saw that the low-cost carriers took a greater market share than the traditional airline companies. Hence, I'd say, or we'd say, that this is a greater threat, yes.
Yeah, and if I can add something, we can go to slide 74, because Lufthansa also has the disadvantage of being in Europe, wanted to increase its market share by acquiring ITA, but this is still under process by the European Commission, because in Europe there are stronger regulation for what concerns monopoly that may not be as strong as in other continents. And probably the deal is not going to happen. And we can also see that they were trying to shift more towards the aviation segment by doing a spin-off of its Technic MRO segment that didn't happen. And hence they were trying to invest more in the aviation segment and the shift out from the MRO and other services segment, but this is not going to happen also because of the stronger relation in the European Union.
Maybe if I can add one thing to that. So Lufthansa is of course doing both. They're doing short range in Europe, and then they're doing international flights to the US, but also, for example, to the Middle East and to China and so on. I think Lufthansa is in a hard place because in Europe, there's super hard competition. There are many players and also many low-cost carriers which have cheaper operations, come from other countries. They have really optimized the operations. And then on the other hand, in the international travels, you compete with wage levels of, for example, in China, in Middle East, and of course the wage level is also going to be lower. So in Europe you have the high competition, and then internationally you also have high competition, and also again the personnel expense, which are much cheaper there.
You mentioned a lot of negative points on the company, and given the structural challenges as well, what would you recommend the company do in order to navigate this challenging period?
I'm happy to speak to this. We believe that our rationals are more like rationals which cannot actively be changed by Lufthansa. German base is a disadvantage. Lufthansa can do nothing about it. They could increase their quality by making smart investments in operational quality. They could try to be more punctual, reducing their 6% flight cancellation rate. This could make customers more happy and maybe increase their revenue in passenger segments. However, they have structural disadvantages which a CEO or someone coming from the outside can't just actively change. And this is why we believe Lufthansa has a very bad positioning for the whole airline industry, and we would recommend you to sell the stock if you own it.
And if I may also add something, and we can go to slide 46, the EBIT slide. No, EBIT slide. However, if Lufthansa, most of the Lufthansa cost is related to EBIT. If we look at the first quarter, at the EBIT of the first quarter 2023, to the loss that we had in the first quarter, in the first quarter 2024, 350 million is only due to strike impact. So in the short term, the first thing that Lufthansa has to address is reducing the strikes and reducing the impact that the strikes have on their EBIT.
And maybe to add even further with this slide, this is a track record that Lufthansa has. Lufthansa has a solid track record in making targets and then missing them. And always Lufthansa management is claiming that these were unforeseen events such as strikes. But if you know that you have a strong labor union which is able to push you really, really hard into high costs, then these are factors you must take into consideration as management. However, management is even in a bad position for this, to make accurate forecasts, because if management at the start of a year says, okay, staff costs are going to increase, the labor unions are going to pick that up and even negotiate even further, because Lufthansa management should not be able to make strong statements and committing to costs for staff before having those negotiations. And hence, Lufthansa has a structural problem when making target forecasts also, as we can see.
So did you happen to look at the debt for the company? Is it starting to show any stressors, either credit ratings or yields? I'm just wondering if it started to play out at all there first.
Yeah, you want to speak about it?
Yeah, I can talk about it. So Lufthansa, to be honest, they're always really on the verge of being investment grade and then junk. So I think now they're investment grade and they want to keep it that way. They have decreased the debt level, but the target for the debt, they have a debt to debt to EBIT level that they want to keep, and they already have this. So I think they might decrease it a little bit, but they're already within their target. So we don't think there's going to be that much changes to it because they already have their target. So yeah, that's going to be kind of it.
Yeah, moreover, they also have 2.5 billion in credit lines that they have not used in previous years. So they're pretty solid on that point of view.
Does the current situation in Central Europe, in Ukraine, have any material influence on Lufthansa or not really?
Yes, it does. Lufthansa cancelled certain flights due to the recent issues, or more or less recent issues in the Ukraine, but also in the Middle East area. Those had an impact, but Lufthansa is not heavily depending on this region for their revenues.
If I can add to that, I think one thing, it was in some parts also kind of good for Lufthansa, because if you know, with the Houthi rebels and the Israel and everything going on, the logistics segment actually improved, and they had kind of unprecedented high revenues in the logistics segment in those years, because of course, like with logistics and shipping becoming more difficult, people are going to switch to air freight, and then the air freight revenue segment revenue was higher than in recent years.
Did a multiple valuation approach. The company also does have an MRO segment that's actually quite lucrative and stable. Would that not deserve some valuation upside?
Yeah, can we show the valuation, multiple valuation slide? We have 3 peer groups for each segment, and of MRO, we have chosen also 2 competitors before us. And we see that in 24, there's a very high valuation for MRO business. This is due to, in 2023 and 24, both Boeing and Airbus companies have some technical accidents with the quality of their planes, and they have to replace even some parts of the planes. And this has significantly caused concerns for the airlines. They have to delay these, put these planes on ground and call for more repairments. And while Boeing and Airbus is dealing with this problem, they also delayed their production, which is already very, very delayed, which means that the companies have to extend the life of use of their current old fleet and also increase again the maintenance service. So we see that this is a one-time occurrence for the increase of revenue of NRO. It's also to the benefit of Lufthansa, because other major airlines doesn't really have a good maintenance service, and this even created group synergy for Lufthansa. But our valuation is based on 2024-25 multiples, which is more forward-looking, and also for the whole group.
As we all know, airline transportation, especially in Europe, is entering into the CO2 certificate regimes. And what's your opinion about it? And how do you think does European airline position differ from airlines from outside Europe regarding the CO2 emission certificates and the environmental issues?
Yes, I'm happy to answer that. Please, 72 slide first, because this is regarding the political uncertainties, and this policy has not been coming out yet, but the rumor has been going on for a long time. So Lufthansa didn't actively take precautions to deal with this carbon trading and carbon pricing, because currently they have the Euro ETS trading scheme, and airlines get enough free credits to compensate for their carbon emissions generated from Europe, inbound or outbound Europe. Has not been a huge issue, but we see that if once this new regime comes out, it will have an only more negative impact on Lufthansa's stock prices and on their bottom lines. On the other hand, what has come out this year is that Germany will also increase the carbon tax, like aviation tax, again, which makes flying into Europe and out of Europe both very expensive, and this could limit the domestic growth of the market. To answer the second part of the question, yes, this puts Lufthansa and also other European airlines at a disadvantage, because international airlines from America, from China, from Turkey, they don't have to face this fierce mandate from the political side. They don't have this pressure yet. So they don't have to take precautions so early, like we talk about SAF. If we go back to the slide 67, if they don't have the mandate, they wouldn't have to buy in the highly priced SAF, and they could have waited until this market matures a little bit and then the prices go down. They don't have to face the strong costs. We know also that this year, actually 2025, European airlines have to take 2% of all their fuels replaced by SAF. And currently Lufthansa does 0.15%. It will be a huge gap and will be highly expensive for Lufthansa to take this amount of sustainable fuel at this price.
So better not to be green.
Yes, but greens are very expensive, and currently the suppliers are not based in Europe. And I also think that since they are American producers of the biofuels, they will also favor the American airlines first, and that will be not good for European.
And if I may quickly add,